Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today by going to www.howtoretireontime.com. Or if you want to buy a physical copy, go to Amazon and search for the book, How to Retire on Time, and you can buy a copy there. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can cover it all. Now, that said, please remember this is just a show. It's not financial advice. But if you want personalized financial advice, you can request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thanks for being here today.
Yep, glad to be here.
Now, David's going to be reading your questions, and I'm going to do my best to answer them. You can always submit your questions by texting them either to 913-363-1234. Again, that's 913-363-1234. Or you can email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, why do people buy life insurance for estate planning? Don't they just pass on whatever is left over?
Yeah, so this is the opposite of what we've talked about.
Okay.
So life insurance for estate planning, half the time I think is a joke, and the other half the time I think it's a very advantageous tool. Now remember, there's no such thing as a perfect investment product or strategy, okay? So if you're buying life insurance to boost your estate plan, that's kind of like saying, hey, I'm going to buy this life insurance. I'm not planning to die this year or next year, but I hope I die soon. I'm healthy now. I shouldn't die in the next 10 to 15 years, but I hope I do, because that's when it's going to make sense.
Yeah.
The death benefit at some point it's not necessarily financially in your best interest if you were to pass when you're expected or later on. You would have been better off just putting the assets in something like the market, and all things being equal, you'd probably have more money to pass in that situation. The way life insurance works for estate planning, in my opinion, is when you have illiquid assets that you want to pass on to your kids that exceed the estate tax exemption. Okay. So if you have an estate, let's say you're a business owner that you want to pass on and your business is worth $5 million and you've got $2 million of net worth, and the estate tax exemption for federally is $12 million and there's no state estate tax, you've got no estate issue.
Okay.
You can pass all that on without an estate tax issue to the kids.
It's under that $12 million line.
It's under the threshold. Okay. Now, there might be some other tax issues to be aware of, but maybe you're passing it on and you get a step up in basis. So step up in basis, it's a fancy way of saying, hey, current price is what they're going to get. So, think of what you bought your house for $200,000. It's now worth $1 million. If you were to inherit that house and sell it, you're selling it with a basis of $1 million, not $200,000. So you sell it, you're not paying taxes on it.
Okay.
That makes sense?
Yeah, I think so.
So if your date of death is in 1 year, you purchased a house for $200,000 years ago, it's now worth $1 million. If you sell it right before you die, you're going to pay taxes on the growth, the $200,000 to $1 million, that's $800,000 of growth. Part of that's going to get taxed.
Okay.
If you just wait until you die, not to be morbid, but then on the date of death, your tax basis is now $1 million. So then your kids sell it, they're selling it based on $1 million. You're not paying taxes on that growth.
Oh, okay.
The capital gain changes.
It just sort of goes away, it sounds like.
So it's like, hey, grandma, grandpa, don't sell me your house. Just gift it to me when you die.
Yes.
That's a more appropriate way to typically pass assets, including businesses, cars, watches, other investments, collectibles, products, whatever it is.
Yeah.
Okay. Now,
so the grandparents' basis was like $200K, but then the inheritor's basis is
the $1 million.
$1 million.
Yeah.
Okay, I get it now.
So when you have an estate now of 15 million, 20 million or so, you still don't need to be worried. If you're married, what you do is you do an AB credit shelter trust. So you work with a practice like us, or you get an attorney that says, hey, when the first spouse passes, cut the estate or the ownership of these different investments or assets in half. So now you have two estates under the estate tax limit. So you can still pass things on, no problem.
Okay.
So again, do you need life insurance for this? No, but I mean, people get paid very, very well to sell very expensive life insurance policies. Now, here's the kicker. If you're single and your estate is greater than 12 million, let's say it's 15 million or 20 million. Now you might hit an estate tax issue. And I think it's like 40%, if I remember right. 40% of your assets above the estate tax exemption is taxed at 40%.
Okay. Yeah. Big bill.
If you're a couple, okay, let's say it's 12 million, so 24 million or greater of total net worth, you're going to roll over in your grave. So if you have a business, a very sophisticated portfolio, and it's difficult to sell, let's say you've got a bunch of real estate properties. You don't want to sell all the real estate properties. You want to keep them in there, but passing them on, you're now crossing the estate tax limit.
Okay.
You might get a step up in basis on the capital gains, but you're still passing on the value of the assets at a higher rate. Do you see how it's different?
Okay.
The capital gains is a tax. The estate tax, the value is different. So now you've got a different issue. So some people will pay for basically life insurance to cover the estate tax so that they don't have to sell certain properties. You're kind of just funding it to basically take care of the tax issues.
So if you die and then the death benefit covers the taxes.
The taxes that you would pay.
Passing it on, I see.
Yeah, so you want to keep the asset where it is. So you're trying to fund a life insurance policy. And if you live to your full life expectancy, maybe the life insurance policy wasn't financially in your best interest, but if you were to die sooner, it hedged against that risk. So life insurance is not an investment. It is the transference of risk to an insurance company.
Yeah.
And there's different ways you can do it. You can do a minimum funding. So basically, if you were to pass earlier than expected, it was in your best interest. But if you live to your full life expectancy, you might need to make premiums to keep the policy alive. Mm-hmm. That's a risk you're going to have to take. Life insurance does get really complicated, but you see how you're just trying to hedge against this tax bill, and how do you pay for it?
Yeah.
That's really what it is. And you can do things like premium finance and borrow money from bank. That's leverage. That can get risky. You can do things, and there's so many ways that you could utilize it. That's the general gist of when it makes sense. It's to hedge against the risk of a tax bill you don't want to pay. The other option is, let's say you do have a business and you've got 3 kids. 2 of the kids have no interest in supporting the business. Maybe it's a farm. 1 kid, you want them to get the asset. The other kids, you don't. You don't want the surviving kid that's going to inherit the farm to have to cough up all the money. That would be rough.
Yeah.
So you can basically pay for life insurance to buy out the other 2 kids so that the surviving kid that's going to inherit the business isn't overwhelmed with debt or having to create this bill, that all your kids get a equal dollar amount, but they don't walk away with burdens or benefits that are uneven. So again, you're using life insurance to equalize the playing field based on your specific situations. It's not an investment. You're transferring risk and leveraging things for certain narratives that need to happen.
And it sounds like this is all very complicated and maybe reserved or better for really high net worth people.
Yeah, most financial advisors will actually kick this stuff to a third party for them to run the numbers because they really don't know how it works. That's not to disparage anyone from it. It's just admitting this is complicated stuff.
Yeah.
We're one of the few that we do things in-house. We quantify the numbers, we check, dot the I's, cross the T's and all that stuff. It is extremely complicated because it's not only a legal matter, it's also a financial matter. It's also an insurance matter. It's also a tax matter. So you're hitting all 4 parts of the financial world, and most people may be comfortable in one of those.
Yeah.
So it is very complicated, but it's very, very important. So again, if you have a net worth of 10 million or less, unless you want to pass sooner than expected and you don't want to tell insurance company, I don't want to be morbid about it, but it's not an investment. It's transferring risk. And if you're willing to pay for that transference risk, then maybe it's appropriate. But I think a lot of people are manipulated into buying life insurance with a death benefit to sell a policy when really it may not be appropriate. But for higher net worth people or people with illiquid assets, it might make sense. Okay. Now, all that said, maybe you think that the estate tax limit's going to go down. There's talk of it going down to 6 million. That would change the game. The tax code's written in pencil. It could go down to 3 million. It could go down to 1 million. No one really knows the future. So maybe that's a concern and you want to hedge against that risk. So again, what is right for you is what you need to solve for, but it has to make financial sense. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.